Hello, everybody. It's Professor Barth, history professor at Arizona State University. Inflation Nation January update. As predicted, inflation continues and it's rising. Consumer prices in December rose 7% from the previous year. This is the highest increase since 1982, so we're talking 40 years. And it's the third consecutive month in which the CPI rose by more than 6%. Now, Jerome Powell just recently acknowledged that, quote, high inflation exacts a toll, particularly for those less able to meet the higher costs of essentials like food, housing, and transportation, end quote. And Powell is correct about that. Inflation has a disproportionate impact on the working class and on the middle class. According to the Bureau of Labor Statistics and the data that just came out, real average hourly earnings, okay, so wages adjusted for inflation, real earnings fell by 2.4% in 2021. 2.4%. So stated differently, Americans on average took a 2.4% pay cut in 2001. If you're making $50,000 a year, that's equivalent to a tax of $1,200. Inflation is a tax, and it's a tax that targets the most vulnerable right up to the middle class. Wages never keep pace with inflation. And economists call this the wage price spiral, where higher prices cause workers to demand higher wages, which in turn leads to higher prices, and then further demands for higher wages, and so on. And before you know it, prices are spiraling out of control. Meanwhile, the Biden administration is in complete denial about this. It's astounding, really. I mean, the messaging from the White House has been just abysmal when it comes to inflation. Jen Psaki a few months ago said that inflation was a, quote, good thing. So they literally have no idea what they're doing over there. But as I've emphasized in previous videos, it really all goes back to the Fed. I mean, the Biden administration will bear the brunt of a lot of the blame for the inflation, but at the end of the day, it's the Fed. M2, and I've said it, I've repeated it over and over, but it bears repeating. You can't say it too often. The M2, which is the primary measure of the money supply, the money supply, as measured by M2, has risen by more than 40% since the beginning of the pandemic. More than 40%. Last time I made a video, it was 37%, so it keeps rising. 40% since the beginning of the pandemic. That is just unprecedented in our lifetimes, and even in generation before that. The Fed's balance sheet, that is its total assets, its bonds, mortgage-backed securities. The Fed's assets have risen from $4.2 trillion at the beginning of the pandemic, which was already just way high, historically high, $4.2 trillion. It's risen from $4.2 trillion to almost $8.8 trillion, which is an increase of 110%. So the Fed's balance sheet has increased by 110% since the beginning of the pandemic. You want to know what's causing the inflation? It's the Fed. It's not, Biden saying greedy businesses. As if businesses all of a sudden in the last few months were like, oh, let's start being greedy. What kind of explanation is that? He's saying, oh, the meat, the meat monopoly. They're just trying to make more money. It's like, what happened in the last few months where before they were altruistic and now all of a sudden they want to make more money? Like, what? It doesn't make any sense. But it's not meant to, really. It's just a bogus explanation for a real problem. This is all result of QE and huge historic purchases of bonds and mortgage-backed securities since the pandemic that the Fed has only recently begun to taper, right? Meaning they're still making those purchases on a monthly basis. Now, the Fed recently decided to accelerate the tapering program, and new asset purchases are expected to end in March. But you have to wonder, like, why have they not ended? Why not end it now? Like, why do we have to wait till March to end these new asset purchases with inflation at 7%? Also, interest rates. The Fed is expected to raise rates at least 3 or 4 times in 2022, but the expectation is that this will be done in increments of a measly 1/4 of a percentage point, which will take us by the end of 22 to a federal funds rate of just 1%. Okay, that's not going to cut it. The Fed's going to have to do a lot more than that. On top of that, the Fed, if it gets serious about inflation, will have to outright sell assets. Okay, not just allow its bond portfolio to gradually run off. That's the traditional way. If you want to reduce the balance sheet, you allow the bond, your bond portfolio to gradually run off. No, just outright sell assets in order to shrink the size of its balance sheet. And some people are starting to call this QT, quantitative tightening. And that's being discussed. It's in the cards right now. All right, but even there, experts are predicting that the Fed will trim its balance sheet by no more than a few $100 billion in 2022, maybe $1 trillion in 2023. Not going to cut it. It's going to have to do a lot more than that. The Fed's going to have to tighten. What does that mean for the bond market, for the mortgage market, for the government's ability to finance massive deficits every single year? What does it mean for businesses, for the stock market, for unemployment? If the Fed begins raising interest rates and selling off assets, which it must do if inflation is to get under control. So the Fed is in a rock and a hard place. This is ugly. And so that's my January update, okay? I wish I had some positive news, but that's what's going on right now. I weep for the dollar, but I've got a lot of videos on inflation, and I got my History of Money course, so if this is your first time watching, check those out. Until next time, peace, God bless, and see you next time.